Yeah, hi, my name is Rohit and I'm the co-founder and CEO of Biz2Credit. Thanks for joining my session, and I'm going to talk about how to build profitable small business loan portfolios for institutional players out there. So we are a marketplace concept. So unlike OnDeck or Cabbage, we have product offerings both from banks as well as non-banking partners of ours. We do SBA, non-SBA, a lot of CNI loans, CRE, as well as we have an institutional platform, which we started in January, February of 2013. And we have done over 2,000 loans in that piece of our platform. And over the last 5 years, we have facilitated over $1 billion in lending and to more than 12,000 plus businesses. And we have the performance data on every business that we have funded till date. And we have different platforms. So we have platform for banks, and we have platform for SBA lenders, and then a platform for institutional players. But the beauty is that we can leverage these different platforms for products which can sit pretty smartly against each other, or say along with each other, and that's what I'm going to walk you through that today. What we have really done is that we have a proprietary scoring model where we have actually used it for every single business owner that has come on our platform. So we have over 200,000 business owners that we have scorecarded over the last 5-6 years. We update that scorecard every quarter, and that includes their personal credit, their business cash flow, industry risk. And since we have the underwriting criteria for all the lenders on our platform, which keeps changing on a quarterly or on a yearly basis, so we get a lot of information from these lenders on their portfolio performances, even if they are not doing it through our platform. So that's like a market intelligence which we build, and then we actually benchmark it to all the partners on our platform, whether they're institutional players or they're banks or we have credit bureaus like Equifax, DNB, who are fully integrated into our platform, both from a data aspect as well as from a monitoring aspect. So what we are really going to talk about is our Biz Analyzer, which is we have the US patent on this, which is a credit scoring model, and which we use across the board for different loans. And this scoring model also changes itself according to the health of the business after they get a loan. So it's not a static model only. And what this does is that we have combined the personal credit, we have combined their business credit, their revenue, their cash flow, their time in business, and also their state of incorporation, where they're sole props, they're C corps, because every state in this country has different rules of how you can lend money even if you're a sole prop or a C corp or an S corp, and not many lenders know that. So from a risk perspective, that's very important. From a compliance perspective also, that's very important, that you should be looking into these aspects when you are looking to build a portfolio, both as a credit risk as well as a compliance risk. And since we run the platforms with large number of banks, so we have a very strong compliance orientation also, and not just a credit risk orientation. So that's something very important. And this Biz Analyzer score is visible to every single small business owner because we give them a dashboard. It changes over a period of time, which could be even monthly to quarterly. We sync all their bank accounts, we sync their payment data, we sync directly with IRS. So every time they file a new tax return, we get the data from IRS directly, and we can incorporate their scores along with the other aspects that I just mentioned. This also includes the underwriting criteria and the performance of all the different lenders on our platform. So that's a market intelligence that we have built in by every industry, geography, region, and age and size of the business also. So this is how we also then recommend business owners the products that what they should be doing. So like say Equifax is a partner of ours, and we actually use some of their business credit risk modeling data to recommend it to both our business owners as well as lenders of what they are doing. And then this scorecard is also used in our risk-based pricing engines that we have built. So as an institutional investor, you don't have to really know about the kind of products that you should be offering or what risk you are taking or what pricing you are taking. You can actually define what kind of yield that you are looking for. And based on that yield expectation, we can actually design products. We can actually incorporate it according to the Biz Analyzer score, and that takes into account your FICOs and everything else, so the known factors, I would say. And on top of it, what it also does is that this also has a simulation tool. So based on the simulation, the business owners can also see that, what if the credit score is today 650 and it goes to 700, so then what happens to their product and pricing. This also benchmarks the institutional product portfolios against bank underwriting norms. So like you can see that how good or bad you are, or how much extra risk you are taking for what kind of an extra arbitrage. If you are gonna, build a portfolio, and then let's say down the line you want to offload some of your portfolio to our banking partners, you can also see that how compliant that would be, both from a credit aspect as well as from a loan sizes and reporting aspect also. So that's something really important. Then, this is the data of our loans, that we have done. And this is the data for the alternative lending. So alternative lending, we really started initially with players like Capital Access Network, Rapid Advance, Swift, and then we graduated towards more of the institutional players who were looking to, do either bigger loans or more longer term loans. So right now we offer loan products in the institutional platform, which are between 1 to 3 years, APRs of between 11 to 20%, and we do a lot of products, including bridge financing, where we combine it with banks. So like you come as an institutional, you give money, and then the banks take you out over a period of time to 3 to 6 months. We have other products that we do, and the default rate in that piece of our portfolio has been 1.3%, and the Biz Analyzer score, the 86% of these loans have a score between 51 to 80. And why I'm emphasizing the Biz Analyzer score here is that we have seen over a period of last 5-6 years, even with our banks and their portfolios, is that FICO score is a very poor predictor of the performance of small business loans over a period of 5 to 10 years. And one very interesting data point in that is that SBA, Small Business Administration loans, which does around 40 billion a year, has a default rate of 1.8% over last 10 years. And this is from the SBA website, so anybody can see it. And on an average, SBA starts doing loan at FICO score 620. So typically what has been considered as subprime, always 620 credit scores, SBA does a lot of loans starting at 620, 630, 640 kind of range. And the reason is what the banks, regulators, everybody has realized after the recession is that when you are doing business loans, you're not just looking at the FICO score. You have to look at the underlying cash flow. You have to look at the underlying assets of the business. Because if you don't look at that and you don't have weighted means for those kind of credit models, and if you are starting to do a lot of business loans just on the FICO scores, it will actually result in more losses when either the economy hits a downturn, or there's a migration of better or higher quality businesses towards more traditional lending. So those are the two aspects that, over a period of 5-6 years that we have seen that, what has happened in the industry. And that's why, for us, the way that we underwrite all our institutional loans is also the way we underwrite all our bank loans. So what we have really done is that instead of lowering the underwriting standards, we have automated every single aspect, every single data point which is used to underwrite let's say, for example, an SBA loan, or a normal bank loan. Because traditionally, those loans are underwritten manually. It's very slow process, it's very tedious process, and it's very episodical. So we said, why don't we combine that, and why not use the technology and external data points and then benchmark it against the underwriting standards which have performed well over last 10 to 15 or 20 years, and use the big data to come up with these models and scorecards, and then constantly keep monitoring our portfolios over a period of time, so that we are able to help both the institutional guys to lower their risk, and at the same point of time provide better products to the business owners. So what we call this as a middle market. So this sits somewhere in the middle of a traditional bank loan, which you can get at 6 to 7% a year. Most of the people don't get that. To a product in the MCA space, which still costs you between 30 to 60% a year. Typically, that is only 12 to 18-month kind of a term. So we said, with these models and the technology and the experience that we have built, why not do these middle market products, which can actually help a large number of customers who are almost bank ready, but they are not there, or they don't have time to wait for a bank to process a loan, and that takes 2 months, let's say, for example, and then keep building these portfolios and then cannibalize part of these portfolios to the banks. So that's the other big thing, that we want that a certain percentage of our portfolio in the middle market should actually get refinanced into bank loans over a period of time, because that clearly proves our hypothesis that if you lend to these businesses at a certain stage of their life cycle and they constantly keep improving, then banks should be able to take over part of those portfolios, which also means better returns for institutional guys, lower defaults, and at the same point of time, most of these customers then come back for more money. So that's something very important, to cannibalize our own portfolios by providing better options to the customers. So we give them a dashboard, we give them updates, we constantly re-engage them, we constantly tell them what better products they can get if they improve certain aspects in their business, and that is something very important. What we also do really well now is that we also slice and dice the data by different industries. So some of the industries here are very interesting, is that construction suffered a big downturn during the recession. And over last 2 years, we are starting to see that construction in certain parts of the country are coming back. So it makes sense that if you are in a certain kind of construction activity in certain states, you should actually get funding now, because if you're just looking at their historical data, you will deny them money. But there's a way to do financing of that and actually get a better yield. We have done the same thing in some of the other industries like gas stations, and also in the food services, in the accommodation. So right now we are financing a lot of hotels and motels which are being bought by multi-unit operators, and they're buying it out from short sales and directly from banks by using institutional money, and then refinancing it back with the SBA loan or with a normal bank loan after a year or 18 months of operating history for that. So like, those are something very important. We actually publish this data now. We also publish our small business lending index, which you can go on Biz2Credit and can see by every single lender class that what are the approval rates. So that will also give you an idea that where banks stand compared to institutional investors to alternative lenders, and then what's happening in the marketplace at any given point of time. We also do it by metropolitan areas. So next week we are bringing out or releasing a study on the top 25 metropolitan areas from a growth perspective of small businesses, both by number of employees and by revenue increase. And that's being covered by CNBC and Inc. actually. So this is just a preview that we also track it by Biz Analyzer scores. We see, compared to applications and the funded, what is the difference, how that is changing over a period of time. That gives us a very good cross-sectional analysis of the industry versus the geography of the businesses, and that also helps us to focus our institutional partners, on what kind of portfolios they can build, because there are two big default reasons in the small business loan portfolio. One is asset liability mismatch, and second is the over concentration of your portfolios within certain industries. So these data points really help us on an ongoing basis to keep monitoring it, because we also provide a portfolio management dashboards to all our institutional investors, that they can see how their portfolios are being allocated, what kind of risk they are taking, what the weighted means of those risks, and then how they can mitigate it. Then we also actually do a lot of work by slicing and dicing the data by ethnic groups, by men versus women. We recently released a study on women entrepreneurs in this country for the second year, where we mapped it by the credit score differential, mapped it by their industry differential, mapped it by the revenue and the EBITDA differential. And this we do by not like really asking that you are a man or a woman, but we actually encourage ethnic groups and women to identify themselves, that if you're a woman-owned businesses, we can help you with more business plans and everything else, where we bear all the costs, but that way we are able to get a lot more authentic data, and then the performance data on part of it. The reason this is very important is that we also see that there are ethnic groups, because the landscape in the country is changing. More and more small businesses are being started or are being bought by minorities and ethnic groups right now. And there's a concentration of certain ethnicities, certain minorities in certain kind of businesses. So this is very important overall, looking to when you build a portfolio, that how the operating margins will change, how the risk profiles will change when you are looking at some of these industries. Yeah.
I'm not sure I understand what the numbers are. That's your proprietary score, and that's like an average in these buckets?
Yeah. So basically what these are is that, so this slide is basically the difference between the Biz Analyzer score of men and women, which is obviously weighted mean of their personal credit, their business cash flow, and, other aspects out there, actually. Since people understand FICO really well, so that's why we like incorporate it, and FICO still plays a role in that. But we also include the other aspects which should be agnostic, like cash flow, revenues, and everything else, and which are actually not apples to apples comparison, So our data shows that. And this is important in the fact that you can even slice and dice or build your portfolios by, you can say, okay, I should have a 20% weighted mean in IT services by, businesses owned by certain groups in certain regions of the country, kind of stuff. So that actually is very helpful. Now, what we are trying to do here is that, we are trying to actually, the whole exercise is that there's no FICO equivalent in the SMB space right now. So we are working very closely with Federal Reserve Board in the country. We are working very closely with US Treasury right now and with SBA to benchmark a lot of their existing performance data with our scoring models and our portfolios. So the aim is that over a period of time, our scoring model should become so robust and so predictive that it should become an equivalent of a FICO scoring model in the SMB space, which can also be used from a pricing aspect. So like you can literally price every single loan by looking at one single scorecard, which combines all different aspects in the space. So like one example here is, this year we did an analysis for first 6 weeks in 29 states because it was the harshest winter ever. So on the cash flow of the businesses by top 10 industries in those states. And we actually saw that how much revenue loss was there and how much margin loss was there. Actually this year compared to last year for first 6 weeks. And now we are actually incorporating some of the weather algorithms into our Biz Analyzer score going forward, that if next year, if this happens or there's a range of temperature or snowfall or snowstorms coming in, how that will impact both the cash flow and the margins. And this is very interesting because a lot of MCA players who had lent money to these industries in these states actually started getting large number of calls from these businesses starting for a request either in respite in payments or slowing down the payments or lengthening their terms. So that's going to impact a portfolio if you build it without taking into account that what could happen. So like this is one example of how we are trying to use the data both from a geographical perspective as well as from an industry perspective, and also by slicing and dicing it by different ethnic groups, because these groups have concentration in different industries in different regions of the country, which I think is extremely important. Then this really talks about how we have funded a lot of businesses in different product sets by different asset classes. The reason why we put these slides were that we have one single platform which does the origination, underwriting, servicing for bank loans and non-banking loans, and that gives us a lot of data insights, a lot of performance data insight on an ongoing basis. And also we have been able to build a lot of predictive modeling now, that where we can say that okay, if a franchise got money through us from a bank, then when they need more money, which a bank might not give, but the institutional player can give, and what is the exit strategy for them at that stage. So that's something that we are constantly doing it. We have built a big, pretty decent sized business in the healthcare space, in the franchise space, in the restaurants and in the food industry. And the reason is that we have been able to focus on the gaps in the marketplace. So one example is that we have a very good business in the gas station industry. And gas stations typically have been considered very high risk industry in the country, but we have been able to map it by their C-store sales, by their environmental issues, and what kind of indemnification is provided on an ongoing basis by different states, because there are states in this country who provide indemnification against the spills in the gas stations. So all these examples are where there are gaps in the marketplace. Banks don't want to do or fund these businesses, or they take too much of time. And these are the places where what we call our middle market products. And this is what we are marketing to more and more of our institutional players, because what we are not really interested is to offer another MCA vanilla product to these guys if they cannot get a bank loan. The whole premise is that these guys should be able to get money at the right price, right term. And in the middle market, we are funding 1 to 3 year terms between $100,000 to $1 million right now. And the loss rate being less than 1.3% has really proven that this model and this product set is working for us, as well as the institutional guys who are looking for decent yields, not too exorbitant a yield, but also looking to build long-term sustainable portfolios in the industry.
Thank you.
Yeah.